Hello my fellow freedom builders and welcome back to the channel. This is a quick update about the swing trading portfolio and why I haven't really posted anything this week. And that is of course because the market has been acting up a bit. I don't know if you have noticed the last couple of weeks we have had some severe, well it's not severe, but it is a 5% drop in the S&P 500 here. But the reason why I say severe is that it probably feels a bit worse than the numbers here show. Now, why does it do that? We have the S&P 500 here, and it actually looks fairly okay so far. Let's just have a quick look for the year, just approximate numbers here. We started the year here, and you could say, well, we are still about 6.5% up. Isn't that decent? I know we were up 20 at some point, but had you just invested in the S&P 500, you would be up. That is true. However, if we try and look at another index, which is called RSP, or the ticker is RSP, that is what is called an equal weighted index, meaning that when we're looking at the S&P 500, you have heard about the Magnificent Seven and the FANG stocks and so on, that all the largest stocks that have been running the fastest this year, they are very highly overweighted in the system, so they're counting for more. So the S&P 500 with these 6, 7, 10 stocks that are really dominating, that is up something like 6.5% this year. If we're looking at an equal weighted index, meaning that every 500 stocks in the S&P 500 have the exact same weight, they each have a weight of 1/1500 part of it, then that index is actually down 4.5% this year, meaning that the difference from this, which is pulled up by the large stocks, and then to this, the RSP, is somewhere around 10-11%. So if you're sitting there feeling that, why can't I outperform the S&P 500? Then this is why. If you haven't been in the largest tech stocks, the Amazon, the Microsoft, the Google, the Meta, if you haven't been in them from day one this year, then your portfolio probably looks a bit more like this, and that is an important thing to notice. We can see the same with the Nasdaq, and you can see here that the normal Nasdaq is for the year up an insane still 29%-ish. But if we take the ticker NDXE here, that is where everything is weighted equally, then that is still okay, but only up around 10%. So the Nasdaq is actually outperforming when you are overweighting these large stocks is up 20% more, which is not really a realistic thing to measure yourself against. So that is a reason why I said that it has been a tough week, and that is because it is looking a bit worse if you are trying to exclude the larger stocks. Also, if we're looking at the Dow Jones Industrial Average, I know not many people are talking about that, but that is the 30 largest mega companies without tech in it and stuff. But you can see the Dow Jones is actually down this year by around 2%. And it is starting to make a lower low, if we're taking this as a low. And you could say, is that really so serious? Well, normally that is the old Dow theory, that if you're looking at the Dow Jones Transportation Average, then if that confirms a drop by making lower lows on a weekly chart, then it actually confirms that we are in a downtrend on the Dow Jones. So when the transportation index is confirming the movement in the normal Dow Jones, then that is a bit more severe. Of course, the reason is that when this is a transportation index, if we are in a good solid uptrend and all companies are doing well, then they need to get stuff transported around the country and the world. So when we see a drop in transportation stocks here of 20% just over a few months here, then that is quite the serious stuff to look out for. So that is one thing. Let's just jump quickly into the portfolio tool here. We have the building freedom. And here you can see that we are starting to see the strength of trying to time your trades, or at least not adding new swing trades to the portfolio when the market is in a downturn. I'll get that with the downturn just in a second. But as you can see here, this gray line, that is the S&P 500. And as I just showed you, if we had taken another if we had taken another index here, it would have looked really bad for it. If we are watching it here, we can see that our total return so far, since we started out at the 29th of May, our total return have been 2.9%. Our max drawdown is around 3.7%. If we're looking at the S&P 500, which is still controlled by these mega companies that is pulling it up, the S&P 500 in the same time span is down around 1.9% and has a max drawdown of 10.2. Now remember this, that there is around close to 5% difference between our total return and then the S&P 500. But we can go up here and edit the portfolio, and we can say that instead of comparing ourselves to the normal S&P 500, we actually want the RSP, that equal weight ETF that I talked about before. Save it here. And you can see our return is still just shy of 3%. But now, since the 29th of May, the RSP is actually down 4.3%. So all of a sudden, the difference is just around 7%, and the max drawdown dropped to 3.4. But that was just to get the point through here. I'll change this back to SPY. Let's just see here. There's no meaning in changing your benchmark during the process just to make you look better. But this is how we're doing right now, and one of the reasons why we are outperforming the market is, as you can see, not that we have stellar results here because the market beat us here, but when the market started to drop, I got out. And that is one of the strengths with being a trend follower, no matter if you're doing it on a longer term time frame or doing it a bit more on the shorter term. You can see that just here back in the end of September we really started to get some sell signals and it started to go out. I could have entered more trades, but I didn't. Now why didn't I do that? Let's try and go into SPY here and have a quick look at the TPI. As you know, the TPI is our proprietary indicator doing a lot of stats work here, and we have the long-term trend down here, and that is green, or it were green. Just have a quick look here. It helped us be in this uptrend, taking a lot of swing trades here in May and June and July. But all of a sudden here at the end of September, it started telling me this is not too good. You might not want to take too many trades. I could also see that the price got under its own 50-day moving average here, but that is not necessarily a reason to drop everything. But when we got to around the end of September, I at least were told by this, please do not take too many new trades. Of course, there could be popping one trade up. I think the Caterpillar, I took that in this period here. But overall, I wouldn't take too many trades in when the long-term trend was red. I was also told the same by the by the weekly TPI here. It got into a bit of oversold, and I think this is where around I took the cat trade because I wanted to take a bit advantage of this, but then it dipped down again. So my rule of thumb, and of course there can be some deviations to it, but my rule of thumb is I'm not adding to my swing trade portfolio when this is in red. Now, a thing I will probably get in the comments or for someone else out there is you can't time the market, you should just be in the market all the time. Well, it's kind of true that you can't time the market exactly, because if I could that, I would have been out here and I would have, I don't know, entered here and I would be a complete billionaire investor guru. But the fact is that I'm not really trying to time the market. As you might remember in an earlier video, I am trying to time the tide. There was this Warren Buffett quote where when the tide goes out, all the boats are dropping in the harbor. And this is what I am trying to to utilize here, that is when the overall market, when the tide is going out, well, then why would I put any new boats into the sea? As I told you, I will try and make a test portfolio where we are also shorting just for the fun of it. I'll probably not do that myself. I do have my option portfolios where I do have short strategies on some credit spreads and debit spreads and different directional trades. But I just try and make a test portfolio just for the shorting of it. But this is the reason why I'm out right now, and no one knows when the market will turn around. If someone tries to tell you that they know the exact, I don't know, Fibonacci point or wherever where the market will turn around, then they are either delusional or lying, because that is simply impossible. No one will know that the market has turned before it does it. So when the market turns, gets above its 50-day moving average, and we start to see some great green colors here on the long-term trend, and hopefully also on the weekly trend, well, then I might consider entering the market again. But so far I am actually very pleased just being out here, watching my portfolio outperform the market each and every day the market drops, and I don't have to do a thing except watching for when the trend starts to be in my favor again. Alright, that's all for now. I hope that made sense. And if you have any questions for this, for the new screeners, for anything that we have implemented in the last week here, just please let me know. I'll put a link to the MyStockScanner below. It's free to sign up, and you can get all the help in here from the videos or from us. If you need some help videos, there is a topic here, and there are a lot of some help videos in here. And otherwise, if there are any questions, just press this button, type your question, or if you find an error or something in here, and press send, and we'll get right back to you. That's all for now. Take care of yourself and your money out there, and have a nice weekend. Bye.